Good afternoon and welcome to the 2025 Roy Morgan Banking and Finance event. Before we get started, I'd like to recognise the traditional owners of the land that we're gathering on, that's the people of the Kulin Nation, and pay my respects to the elders past and present, and extend this respect to all Aboriginal and Torres Strait Islander people, and particularly their children, who carry the promise of our shared future. Now today, artificial intelligence, AI, could lead to human extinction within 20 years, according to 25% of Australians. And that's up 5% in just a couple of years. The majority of us, 65%, believe that overall AI causes more problems than it solves. And that too is up. That's up 8% in just 2 years. So we're really a little worried about this AI stuff. Many people, I think that the evolution of AI is just like any other change, like the wheel or flying or the internet or automation, etc. Scary until it becomes like the status quo. My own view is that AI is much more like IVF, like test tube babies and everything that flowed from that, creating life in its potential for extraordinary far-reaching impact. The decision-making around IVF, and many of you will remember if we go back 10 years or so, was much more multi-layered. It was all about values, it was about ethics, religion, human rights. These were the issues surrounding that, very different to the wheel. And these issues needed all of our best brains, our most collaborative teams of people, and an extraordinary degree of trust as we tried to look forward. And we're still dealing with the unforeseen consequences of the decisions that were made years ago. And I say this because finance doesn't exist in a vacuum. In fact, while finance underpins and probably drives our economy and particularly, our productivity, it also exists kind of in the eye of a storm. And that is whatever storm is happening at the time. And at the moment, it's definitely AI. So today, what we're going to do is review the overall financial landscape and explore the trust and distrust of banks, superannuation, wealth management, insurance payments, cards and loans. Importantly, we'll then look at the Roy Morgan innovative benchmark risk recovery rate. That'll become clearer later. It's pretty important. And look at how the brands that are struggling to repair their damaged reputations are doing. And finally, the alarm signals triggered by the Roy Morgan risk magnitude scale. So settle in for the journey. First, the landscape for Australians and the economy is not, I'm afraid, an entirely rosy scene. Consumer confidence has failed to return to the neutral level of 100. So 100 is where equal numbers of people are positive or optimistic and pessimistic. And consumer confidence has failed to return for that for an astonishing 43 consecutive months. That's the longest period in more than half a century. And over the last 2 years, confidence has been stuck between 80 and 90, despite 3 Reserve Bank interest rate cuts in 2025. Now, mortgage stress has improved since reaching a 15-year high in 2023-24. However, more than a quarter of mortgage holders are still at risk. They're still essentially at risk of mortgage stress. That's 1.4 million mortgages at risk right now. So interest rates started rising in May 2022, and yet despite those 3 interest rate cuts in 2025, consumer confidence among mortgage holders is still down by more than 20 points. Let's look at wealth. And on the face of it, the nation's wealth looks more positive. Net wealth grew by $930 billion in the 12 months to March 2025. That's a rise of 8.3%. That growth was driven principally by the economy's 2 major asset classes, owner-occupied homes and superannuation. Owner-occupied homes grew from $782 billion to $857 billion. It's kind of hard to get your head around those numbers, isn't it? Between March 2024 and March 2025. That's a 9.6% lift. Superannuation grew from 3 trillion to 3.14 trillion, a 4.5% lift. However, once you account for inflation and adjust for CPI, the current level of gross personal wealth is only 4.7% higher than in March 2024. And the average wealth per head or per Australian grew by only 1.9%. That's from 331,000 to 337,200. So it's not massive. So per capita net wealth remains higher for baby boomers at 957,000 than it does for the interwar generation, the earlier ones, at 902,000, or Gen X at 706,000. Again, once we adjust for inflation, net wealth per capita increased most for baby boomers. So they're the highest, and it increased most for them, up 4.5%. Interwar, the older ones, up 3.3%, and Gen X up 2.7%. No wonder my children are annoyed. So let's just dwell on that for a moment. The average net wealth of each Australian is $530,200, but for a baby boomer, it's $957,000, 80% more, almost twice. On a darker note, and this is really important, Roy Morgan's identified a group that we call disaffected Australians. And there are now more than 1 million, well over 1 million of these outliers who feel they get a raw deal out of life. They don't trust the government, and they believe the fundamental values of Australia are under threat. So this population cohort spiked during COVID, as you can see there, and has continued to grow now year on year. So our data shows that this group believes the government no longer represents them. It's no longer relevant for them, echoing the kind of sovereign citizen creed that laws and institutions are illegitimate. They're overrepresented, more of them, in regional and outer suburban areas, precisely those areas where sovereign citizen ideology has taken root. Politically, they're drawn to fringe parties like One Nation, 2.5 times more than the national average to vote One Nation. So there's some interesting currents going on. So this is the context within which we look at the increasingly important topic of trust and distrust in Australia. Many of you will already have heard me say that trust is the foundation of all human connections, and it is. But before we get into the data, let's be really clear about definitions. Trust isn't just somebody liking a brand. It's actually an expectation, an earned expectation, that a brand will do the right thing even when nobody's looking. And distrust, on the other hand, is not simply no trust. Distrust is an active suspicion that a brand will put itself first when it matters most. And that distinction is absolutely critical because distrust is far more damaging and volatile than a lack of trust. So trust is the accelerant for business growth. A global Deloitte study makes the business case for trust really crystal clear. Trusted companies outperform distrusted ones by a factor of 2.5 to 1, 2.5 to 1. And 88% of customers who highly trust a brand say they'll come back for more, which shows that trust drives repeat behaviour and lifetime value. In short, trust just doesn't shape reputation, it underpins sustainable growth. But it's distrust that we fear. And if we don't, we should. Distrust is powerful because it feels like betrayal. It's not just disappointment, it's that sense that we were wrong to have trusted too much in the first place. We feel foolish that we trusted too much. And that's why distrust rises so quickly and cuts so deep. This chart shows how distrust builds. It starts quietly with a little bit of doubt, then it grows into suspicion, anxiety, and fear. Eventually, people move to self-protection, switching providers, withdrawing support, or even becoming active opponents. Understanding this trajectory really matters because once people reach that self-protection, it's almost impossible to win them back. So it's really, really important to point out that distrust isn't just reputational, it's financial. It destroys brand equity faster than almost any other force. It's what investors misread as market volatility, when in fact the market is repricing risk. In the last few years, we've seen the real cost, billions wiped from balance sheets, customers walking, and importantly, regulators intervening. That's why measuring only trust misses the point. It's the spread between trust and distrust that tells you the real health of the brand. But once distrust takes hold, the damage compounds, people stop listening, they stop buying, and they start warning others. These are some of the biggest examples of distrust as a financial problem. Medibank lost $1.6 billion of market value in the days after its data breach. AMP's market cap collapsed by 80% after the Royal Commission. Facebook lost $120 billion after the Cambridge Analytica scandal. Rio Tinto lost $4 billion in value following the Duke and Gorge incident. Qantas lost 30% of its value after a series of scandals. The lesson's clear. Distrust makes even healthy, profitable brands fragile. And the financial damage is immediate and severe. Distrust, I think, is a hidden liability. It's like off-balance sheet and compounding until it suddenly falls due. Social scientist Dr. Ross Honeywell and I were invited to contribute a chapter to a groundbreaking new book on trust and distrust in Australia, edited by ABC executives Tracy Kirkland and Gavin Fang. It was called The Age of Doubt. The book casts doubt on the dominance of trust in society. The reason I'm telling you about this, not only we're proud to be part of the book, but is that legendary journalist and Canberra University academic Michelle Grattan wrote about the book, "Trust is the golden thread that binds our democracy, yet it's fraying," she says. This book is a rich and diverse trove of information and opinions on dealing with the central issue of our time. So hold that thought as we turn to the data, because as you'll see next, since COVID, Australians are far more likely to distrust than they are to trust. So this chart illustrates the significant shift in the national mood over the past 5 years. Quick housekeeping moment. Green bars are trust, red bars are distrust, and that black dotted line is the net trust or distrust. So during COVID-19 pandemic, Australians experienced government and institutional interventions unlike anything else in living memory. New and often shocking controls over our personal freedom accelerated a shift from trust towards distrust. Since 2020, far more Australians have nominated distrusted brands than trusted ones. In fact, in the 12 months to August 2025, almost 68.5% of Australians nominated a distrusted brand, at least one, and only 45% nominated a trusted one. That's close to double the proportion distrusting compared to late 2019. And since COVID, this shift to systemic distrust has been exacerbated by the cost of living crisis. During this crisis, Australians began to notice and dislike, even despise, profit triumphalism. So much so that now the top reason for distrusting brands is that they're too focused on profits, while everyday Australians struggle to put food on the table. Now, despite the efforts to balance the tension between shareholders and customers, Coles, Woolworths, Qantas and the Big Four banks all experienced significant increases in distrust for appearing overly motivated by profit. And this illustrates how quickly public sentiment can shift direction and deteriorate when broader economic anxiety stains the social fabric. Now let's look at how this shift to distrust is impacting different industry sectors. This chart illustrates the position of various industries, all of the different industries, on the trust-distrust spectrum. So on the left, consumer products, retail and services are among the most trusted. But look to the right, that's where distrust dominates. And crucially for this event, the banking industry is now the 14th most trusted in the nation, alongside insurance at 12th. That said, the banking industry is the big improver compared to last year, lifted by the big four. The insurance industry ranked 12th and boosted by roadside assistant brands associated with some general insurers, has slightly more distrust than trust, but just slightly. Ranked 6th with more trust than distrust is superannuation and wealth management, that sector. And followed in 7th place is the payments, cards and loans sector. Now, all banking and finance sectors improved compared to a year ago. In the next section, we'll explore the latest rankings of Australia's most trusted and distrusted brands and take a closer look at how key players are performing, where they stand in the ever-changing landscape of social attitudes and opinions. So starting with the nation's top 20 most trusted brands. Here they are. And looking first at the banks, so Westpac is the big improver. In August 2025, it was up a massive 157 places in a year since August 2024 to 15th position. So from way down there to 15th. The Commonwealth Bank jumped 6 spots to become the 7th most trusted overall and the number 1 in bank rankings, moving ahead of Bendigo Bank. NAB jumped 156 places, mainly due to a decline in distrust, and ANZ jumped 146 places since August 2024. So the big four banks have made some major strides. In contrast, ING fell out of the top 20, becoming the 21st most trusted brand, just out of the top 20, while the previously most trusted bank, Bendigo Bank, fell 3 places in the last year to 14th. So although ING has fallen out of the top 20, this is mainly because the other brands have experienced dramatic improvements, kind of giving them that leapfrog thing and pushing ING down rather than ING getting worse. So that's trust. But what's happening with the most distrusted brands? The leaders of distrust, I guess for everyone in the room, are sadly familiar. Woolworths and Coles remain at the top, followed by Facebook, Optus, even before the latest September 18 outage, and Temu. Each of these cases reflects not just a brand in reputational crisis, but a broader category of impact. So when Woolworths or Coles stumble, it damages trust across the supermarket sector. And when Qantas falters, the whole airline sector feels the impact. Similarly, Optus's woes have impacted the entire telco sector. And that's the key point. Distrust doesn't stay contained within one brand. It creates systemic fragility and risk across the whole category. So let's focus directly on banking and the finance industry. The banking industry, that's the blue line, has recorded a strong improvement, as I said, in net score since mid-2024. Pretty extraordinary. The super and wealth management sector, that's the yellow line, has improved more gradually over the longer term. Payments, cards and loans, the black line, and the insurance sector, the red line, have also improved since mid-2024. So all sectors now are reaching their highest levels in more than 4 years. Currently, 48 brands are tracked in the Roy Morgan Risk Monitor in this banking area. And we can see after 5 years in net distrust, more red than green, the banking sector's 12-month average now shows trust and distrust have reached parity. Look at the green trust bars and the red distrust bars converging, and that black net line lifting to 0. A word of warning though, previous upticks proved temporary, so the test is whether this one holds. But this is really interesting. Many Australians express distrust in banks in general, rather than naming a specific brand. So we say, which brands or companies do you trust? And which brands or companies do you distrust? And a whole bunch of people say banks in general. They don't nominate a particular one, so they just say banks in general, saying they distrust all, most or some banks. So look at that sea of red. And it really is a big sea of red distrust. Distrust rose sharply during COVID as banks were seen as profit-driven and unethical. It recovered slightly in late 2022, then deteriorated again in early 2023, following the majors' half-year profit triumphalism, reinforcing perceptions of unaffordability. There's been a slight recovery over the past year, again, largely driven by the Big Four. And the Big Four banks themselves have been steadily improving since COVID, with distrust easing and trust building momentum. The green trust bars now outweigh the red, and the black net line has climbed to its highest level in 5 years. That's a clear sign that Australians are slowly re-engaging with their major banks. Though with so many changes at the top of the Big Four, those gains may be fragile. We're watching this really closely. The Commonwealth Bank, the biggest of all, has taken out the 2025 Roy Morgan Most Trusted Bank Award, marking a clear signal that its long rebuild of trust is paying off. For the non-Big Four banks, trust clearly outweighs distrust. So lots of green there, not too much red, not too much distrust. The black net line stays well above zero. So Australians continue to see these non-major banks like Bendigo and ING as more customer-focused and relationship-driven, maintaining strong positive sentiment, even through that cost of living turbulence. And banking overall, the blue line, has risen steeply, driven by gains in both the Big Four and the other banks. On current trends, though, the Big Four are set to overtake those smaller, more community-focused banks. And this is a very rare moment when the major players are more trusted than the previously dominant, well-loved smaller players. The Big Four then have rebounded strongly since the Financial Services Royal Commission, with NAB and Westpac now closing in on Bendigo Bank and ING, both of which are slipping. Our data shows a striking reversal. The major banks, once the most distrusted, are now overtaking the very brands long seen as the trusted alternatives. Over the past year, the top reasons for trusting banks have lifted across the board. More people are trusting banks because of strong customer relationships and customer-focused reasons, good service. Reliability and dependability is also trending up. So these lines show a broad improvement since the recent 12-month mark, again, largely driven by the Big Four. No problems, satisfied, trustworthy have ticked up a little bit more modestly. On the flip side, the dominant driver of distrust remains the perception that banks are too motivated by profit, especially during the cost of living crisis when families are struggling. Unaffordability, that's unaffordable fees, poor service, and concerns about ethics and honesty also feature strongly in reasons for distrust. So ethics, dishonesty, they're the kind of things that come through in distrust, very different to trust. Mentions of profit-driven behaviour have eased slightly over the past year, but still define the public's distrust of both the Big Four and banks in general. Men tend to trust banks more than women do, and trust generally increases with age. Men also show higher levels of distrust than women, particularly in the Big Four, and distrust tends to rise with age before easing among those 65 and over. And despite their dramatic recovery, the Big Four continue to attract far more distrust than the smaller community-focused banks. Trust in both the Big Four and other banks is highest among homeowners, followed by those paying off a mortgage. Renters show the lowest levels of trust. Distrust in the Big Four is led by homeowners, followed by those paying off a mortgage. Now, why am I showing this? Why am I showing you this conundrum? How can men be more trusting and more distrusting? How can people who have mortgages be more trusting and more distrusting? This is so, so important. And I show you it not just to show you the world that we live in, because often human beings are totally weird, but because I want to demonstrate really practically how distrust is very different from an absence of trust. If we just looked at trust, we'd be saying men are more trusting and people with mortgages are more trusting. Therefore, our problem must be women and people who don't have mortgages. So wrong. What we really need to understand is who distrusts us. And the answer is men and people with mortgages. So again, I'm raising this point that distrust is not just an absence of trust. It's a much more deep, visceral, important, powerful thing. And if you're not looking at distrust, you run the risk of getting it really, really wrong. Let's look now at super and wealth management. Currently, there are 34 super and wealth management brands tracked in the Roy Morgan Risk Monitor. Net trust in this super and wealth management industry has risen steadily since 2019, driven mainly by a sustained fall in distrust. See the red lines coming up there? The red bars have narrowed year on year, lifting that black net line into positive territory. Even with the recent issues like the Australian super cyber attack, trust continues to outweigh distrust, marking a real, genuine improvement or recovery for the sector. And the 2025 Roy Morgan Most Trusted Super and Wealth Management Award went to Australian Super. Currently, there are 52 insurance brands, as we turn to insurance, tracked in the Roy Morgan Risk Monitor. Now, look at this. After a really solid long decline from 2019 to 2021, the insurance industry was hit hard by the Medibank cyber incident, which sharply increased distrust. Since then, distrust has eased asymmetrically, and the black net line is now rising towards positive territory for the first time in 5 years, signalling a kind of tentative recovery despite the recent scandals and the industry's overall distrust. As in the banking industry, many Australians, when asked, nominate all insurance companies or most insurance companies as who they distrust, rather than naming a specific brand. So this is an industry thing. And the chart shows that while trust in the sector remains almost non-existent, very few people say, oh, I trust all insurance companies, or I trust most insurance companies. But they do say, I distrust all or most insurance companies. This improvement reflects a slow stabilisation, not renewed trust, but less active hostility towards insurers overall. Interestingly, as we saw on the previous slide, distrust of insurance brands increased after the Medibank cyber attack, while on this slide, distrust in all insurance companies fell. Now, we think this is likely reflecting a shift from a kind of diffuse, category-wide distrust in insurance companies, and people had somewhere to focus their blame. So this was Australians actually directing their anger at Medibank rather than the entire sector. IAG's flagship insurance brand NRMA this year won the Roy Morgan Most Trusted Insurance Award. So payments, cards and loans, we track 20 of these continuously. And distrust in payments, cards and loans spiked sharply through COVID, but began easing in 2021. The Latitude Finance cyber incident in 2023 briefly reignited distrust, but since early 2024, the red bars of distrust have steadily shortened, while trust has held firm. The result is a slow but distinct improvement, with the sector regaining stability and net trust after several quite turbulent years. In 2025, the Roy Morgan Most Trusted Payment, Card and Loans Award was awarded to PayPal. I'd now like to introduce to you, as well as measuring these things and reporting them, we do a lot of analysis, and I'd like to introduce two really genuine innovations here at Roy Morgan. As I've said, everyone measures trust, but only Roy Morgan measures distrust. In fact, I think it's safe to say that Roy Morgan leads the way in tracking and reporting the impact of distrust from reputational crisis and in mitigating that distrust to drive positive recovery. So the first innovation is our benchmark recovery rate. I'm often asked by CEOs or somebody who looks at their brand and sees that it's really dipped, they'll say, well, how long does it take to get better? And I know that they're hoping that I'll be able to say, give it a year or maybe 18 months or something like that. After being asked that many times, I decided that, this was actually a really important question and we should put some science to it. So the Risk Lab team analysed and modelled the recovery rates of 17 major brands that had been impacted by dramatic reputational crises over the past 7 years, and found that the recovery process is non-linear and fragile, and that in many cases the effort required to rebuild trust is greater than was needed to lose it. No surprises there. And that recovery takes much longer than expected. For example, after 12 months, 92% of brands hadn't fully recovered. After 2 years, 75% hadn't recovered. 50% still hadn't recovered after 4 years. And even after 5 years, 20% hadn't fully recovered. If we look at an average of how long it took these 17 brands to recover, this is what the benchmark recovery rate looks like over a 5.5-year period. What's interesting is if you haven't achieved good recovery in the first 9 months, the next 4 years are a real slog. So, have the big four banks recovered after the Royal Commission into misconduct in banking, superannuation and financial services? Kind of. The Commonwealth Bank's recovery has generally followed the benchmark recovery rate. They're monthly figures for the Commonwealth Bank, and you can see how it's generally following that benchmark recovery rate trajectory, though it's been relatively volatile. It took 66 months, almost 6 years, to get back to a strong position. However, it doesn't yet qualify as a stable recovery. We're looking for 6 months above the 100% full recovery line, but it's close. NAB's recovery has consistently been above that benchmark recovery rate trajectory. It still took almost 5 years to achieve, close to a stable full recovery, that elusive 6 months above the benchmark, but you can see NAB really was way ahead of the benchmark, way ahead of the average recovery trajectory. ANZ's tracked broadly in line with the benchmark recovery rate, but even after 5 years, it's still zigzagging across that benchmark trajectory. And Westpac also broadly tracked in line with the benchmark recovery rate, following large swings early on. You can see lots of things going on in that early part of the recovery. It doesn't qualify as achieving full stable recovery yet. Interestingly, the average recovery rate of all brands dips after 5.5 years, but a full and stable recovery is getting back above 100% for at least 6 months. So that's one. The next one, our second innovation, is an early warning system for brands. So using our monthly scores, our Risk Lab devised the Roy Morgan Risk Magnitude Scale, which can be applied to brands that we're tracking. So our clients receive alerts when distrust reaches predetermined danger levels. A word of warning, the previous recovery rate, those slides were built on net trust or net distrust. The risk magnitude scale algorithm is built only on distrust. Risk comes from distrust. So the following slides are built purely on distrust. So how does it play out for the big four? Well, our magnitude scale has 3 tiers: alert, high alert and crisis. So after sitting deeply in crisis and high alert following the Royal Commission, CBA's distrust, the red line, has steadily reduced and has held above the alert band for more than 3 years. This sustained improvement explains CBA's elevation to Australia's most trusted bank in 2025. NAB spent 3 years after early 2018 inside the crisis high alert or alert zones, but from May 2021 it achieved a meaningful turnaround and the red line now sits above the alert threshold. This reinforces NAB's significant recovery under the influence of former CEO Ross McEwan. ANZ spent more than 2 years in and out of alert, high alert and crisis zones. See that early part there? But since July 2020 has stayed mainly out of alert status after briefly being on alert late last year. ANZ's now moved decisively into the no alert zone, suggesting a new phase of reputational stability and resilience. Westpac chart shows a sharp fall into crisis following the AUSTRAC money laundering scandal, followed by a long period of reasonable stability since April 2022. Now finally, Woolworths. The magnitude scale reveals the model's real, true predictive value. In October 2023, I was able to take Woolworths CEO aside and quietly tell him that after 3 years as the nation's most trusted brand, Woolworths was heading for a reputational crisis. At the time, it seemed unthinkable, unbelievable. After all, we were talking at the same ceremony at which he'd just accepted Woolworths Award as the most trusted brand in Australia. That conversation was 14 months before we unhappily announced that Woolworths had gone from the nation's most trusted brand to its most distrusted. The signs were there in this risk magnitude scale. In conclusion then, across the financial sector, the turnaround has been remarkable. Banks, insurers, super funds and payment companies have all restored trust to its highest levels since before the Royal Commission. The Big Four in particular have rebuilt to a point where none are even in alert territory. And the Commonwealth Bank now leads that field in trust. Still, the timing is significant. With government and business now focused on cutting red tape, the recovery of bank brands gives the Australian Banking Association and the major banks, or the banking industry, a credible platform to argue for measured deregulation. Proof that cultural repair can earn the right to lighter oversight. Yet the paradox remains. Australians still talk about banks in general with deep scepticism. The system as a whole is trusted to keep money safe, but not to act with fairness or conscience. That lingering distrust keeps the sector one of the most regulated in the economy. Wrapping this up, we've looked at what drives distrust and how difficult recovery can be. The natural next question is, so what actually builds trust? What shifts Australians from suspicion to confidence? From 7 years of continuous research, we've identified the 10 qualities that seem to consistently drive trust across the industries. They're about skills, problem-solving, consistency, reliability. Others are about values, putting the customer first, telling the truth simply, decency, a decency principle, and leadership in a crisis. And increasingly, Australians reward brands with strong environmental credentials and those that protect data and privacy. The big point here is that trust is built not by one thing, but by the alignment of competence and values, delivery and decency together. Remember that trust is borrowed and must be repaid every day. And that's the end. That's a wrap. Before I close, I need to say that this Roy Morgan Risk Monitor is a really important part of the Roy Morgan business that surveys around 20,000 Australians each year on their trust and distrust of brands, and this doesn't happen by itself. It takes real dedication, deep intelligence, great data science and teamwork. So I really want to acknowledge the work of David Laffin, head of our Risk Lab, and Adam Ray here, and Lisa Kai, and our social scientist partner, Dr. Ross Honeywell, and the whole team. Because it is a bit of a team that everybody wants to come and play in, I have to say. So that concludes the formalities. Questions? Any questions from anyone? And then we'll have some hospitality.
Michelle, I'd love to know what the reaction of the Woolworths CEO was when you gave him that contrasting news that day.
Yeah, he's Yes, probably still a friend. So that was Brad Banducci, and that was before the famous kind of storming off. But actually, look, I have to say, I found Brad a really incredibly impressive person. He immediately said, "Why? What is it?" And he started to run through a list of things that he had in the back of his mind that could be of concern. So he at the time was actually thinking about, automation of the not tellers, the people the checkout people, and also the idea of actually watching people, as they were in the shops. But facial recognition. Yeah, facial recognition. Thanks, Ross. But the key point was, many people go, "Oh, what rubbish! That's what are you talking about? That's not that much trust," or whatever. He was not like that. He was deeply interested to understand.
Thanks, Michelle. That was fantastic. How do you rationalise and provide a hypothesis around how bank trust and lower distrust has happened for individual brands versus the overall distrust of banks generally?
Yeah, it's a really, really good question. It's not sort of about rationalising it. I think the key thing is it just what people say. They don't trust the banking industry. And you often find this in an organisation. I don't trust management, but my supervisor's absolutely fabulous. And I think we're already starting to see that where you go, look, I don't trust the banks, but look, my particular branch is quite different. So there can be that kind of thing going on. But I do think that the banks have put a remarkable effort into trying to improve for their customers the way that they interact with them and being clear and precise, but that's probably having an impact on their customers and their conversations. It is interesting though, because there are some other industries where you've actually got a really trusted industry, and then, because generally retail's trusted, and then you can have a couple of really distrusted brands.
So do you think that then this face-to-face personalised approach is coming out in that, that generally I don't trust a bank, but, my bank manager that I work with is fabulous. So is that telling us something about the way people want to interact with brands? Really
interesting. That was a point that Robert Gottliebsen made. He talked about, particularly he was thinking about banking and the personal contact. And the point he was making, and I agree with him, but I suspect we're not 100% right. But what his point was is that it's all very well to deal with an online system or whatever when everything's going well. But then when you have a problem, something goes wrong, that's when you actually need to have human contact. And that time when something goes wrong is an opportunity not only to solve the problem, but to actually feel this rush of gratefulness and warmth towards an organisation because they helped you. So there's very much a personalised opportunity when things go wrong. And I think, during COVID, lots of things were going wrong. So that was a time when everyone was tested. But today, it's very interesting. We're seeing the big four are getting just better and better with their online services. They're pretty flawless, really. And so we've become used to it. We've become used to the frictionless approach to doing whatever we need to do. And I think what we're seeing, I really think what's happening with the other banks like, say, Bendigo Bank. Bendigo Bank has always been community, personal. You expected the people. And as everyone has to move away from the cost of actually having people standing around doing things, they're now facing a little bit of the, backlash because everybody expects them to be personal and wonderful, whereas the big banks have been through that long ago. So, sort of a cycle kind of thing. Yeah, as I said at the beginning, AI will be the end of the world in 20 years, according to 25% of people. I'm probably one of them. Actually, how many people in the room would be part of that 25%? And willing to admit it? No, nobody. Nobody's that brave. No, but, we are in a really changing environment, and people are having to learn to trust things, having to trust bots, having to trust systems. And the more those systems work in your favour really easily, the more likely the trust is able to be built. But, it's going to be a rocky path as we go through more data breaches, as we find fake things happening. It'll be a really interesting challenge. And it's one of the reasons why we think that trust is so, so important. When things are dicey, if you don't trust your bank or whatever, you're just going to be so hesitant to do anything. I mean, one of the groups that I think are really struggling are the charities, because I know if somebody rings me, even if I want to give them some money, there's no way I'm going to give somebody, even with a really nice voice, my details, my credit card details. So that day's gone. And that was a really big source of income for people. So we have to learn to change.
What is the correlation between, say, Aldi becoming the number 2 trusted brand and Woolworths and Coles taking a massive dip, for example? Is there a relationship between competitive activity and trust and distrust? So, say, for instance, with the Big Four now increasing, yet ING and Bendigo, perhaps dropping off. Is there a relationship between the competitive activity and the barometer of trust and distrust?
I think in both those cases, it's the Woolworths and Coles phenomenon is a really interesting one. The way that we've understood it is to say we watched during COVID both Woolworths and Coles, but particularly Woolworths, actually, and Brad Banducci in particular, set out to save Australia. I mean, he personally sent us texts telling us when toilet paper would be available in the stores. Remember how important that was? That was, life-threatening. And I just loved getting those texts. He was there. He was keeping us safe. He was making things available. They were just going whatever it took to keep us fed and safe and healthy. And we loved them for it. Aldi, on the other hand, just kept on doing cheap prices, didn't do anything special. So Woolworths and Coles overtook them. But Aldi didn't kind of fall in a heap. They just didn't take any kind of thing. And then what happened is that Aldi just kept doing that, cheap prices, cheap prices, cheap prices. And Woolworths and Coles emerged from COVID and kind of didn't realise that we were in this war against prices. That, after COVID, we weren't going back to normal. We were going into a major cost of living crisis. And so they weren't prepared or ready for the impact that prices would have. Aldi, sitting there, cheaper prices, was just perfectly pitched for the cost of living. So they just kept going. And Coles and Woolworths just got rammed by, being claimed that they were price gouging and all sorts of things like that, which was just, of the time. So I think that's the issue rather than a competitive landscape. And I'd say, as I said earlier, I think for the more community personal service banks that are having to become more automated, that are having to move into that space, the pain that their customers and people feel is happening now, whereas it happened for the others some time ago.
Thank you. Why do you think is superannuation such a trusted sector, and do you think that might change in future? Are people going to start questioning it more?
Look, I often wonder that myself. I think the superannuation sector, basically, so long as it's making money for people and they can actually see their balances going up, there's a certain amount of trust. If there's a great scandal, and, I've been surprised to see that, a couple of super funds that are found to be not so honest hasn't had a big dent on the super fund in general. But I think basically people don't have that much of a relationship with their superannuation fund. It's just there. They can see the dollars going up.
Hi, Michelle. Great presentation. I just had a question, actually, more like, what do you think about consumer confidence being low for 43 consecutive months, and what do you think it's going to take to even get close back to that 100 threshold?
I wish I knew. But look, seriously, I think if you look at any of the measures, any of the economic measures, not too many good ones. So basically, Australians, the consumer confidence measure is all about, it's about 5 questions. The first one says, how are you and your family doing now compared to last year? And people don't feel like they're better off now. It's a while since they felt more better off than they were last year. Do people expect to be better off next year than this year? And the answer is not really. So all of the essence underpinning that, there's not a lot of optimism about the economy and our own wealth and our own families' well-being. And then the other part of it is where we're asking about people's expectations for the economy for the next 12 months and then the next 5 years. And then is now a good time to buy things? So the one that does seem to occasionally pop up is, now's a good time to buy. But really, we are just not seeing that everything's going well. And it's not going to improve while we've actually got lots and lots of companies sacking people. So the one thing that appears to be holding is employment. The Roy Morgan unemployment is much higher than reported by the ABS. We're still seeing unemployment around 10%, whereas the ABS will have it at 4 or 5 or something like that. But the critical thing is today, unemployment and employment, they're so different. We will never have a massive level of unemployment while we've got Uber drivers and all of this real gig economy. But people who are Uber driving and bits and pieces like that are not going to be feeling too good about how their family's going now. They're getting by if they can. So it's hard to see that it will actually improve until the economy really substantially improves.
Today, the Reserve Bank brought out a higher inflation figure, and that'll have a real impact. The stock market went down, and the
interest rates won't go down?
Interest rates won't go down. And so it's going to be a bit tough. Therefore, Michelle, you better give another presentation on each of the banks, say, in the new year, because I suspect that you'll find the images of some of these institutions will decline, and it's because of the Reserve Bank. And of course, the other thing we've got to think of is the massive strain between the US and China and the rest of the world. And that is not helping anyone.
Yeah, I think those things are actually floating around in our subconscious, aren't they?
Anyway, I think we've all got to thank Michelle for a wonderful presentation.